Hey everyone, welcome back to the Daily Gold Podcast. Today we're chatting with Tiho Brkan. He's the author of The Short Side of Long blog, and he just started a free newsletter, so check out his blog. You can sign up for the free newsletter every 2 weeks. He has a great newsletter that he sends out, and Tiho is also a fund manager based in Hong Kong. Tiho, it's great to talk to you. How are you doing today?
I'm doing very well. Always a pleasure to be on your show.
Well, thanks. It's always a pleasure to have you. And, Tiho, let's get right to it. Last time we talked, you said you weren't worried about a potential breakdown in the metals because it would wipe out the excessive sentiment. It would wipe out the fact that there hasn't been a down year for 12 years in precious metals. Also, I already mentioned the 20% thing, but I guess, given that we've had the big move down, what is your state of mind right now?
Well, in retrospect, when we look at the way the precious metals have behaved, obviously certain assets have peaked at different times and certain assets have corrected of already a large magnitude, and others have been lagging. So, for example, silver has corrected a large amount already in 2011 and 2012. And gold has really stayed near the peak of 1900, very close to it for majority of the time. And then gold miners have been the recent culprit of receiving all, or if not majority, of the selling force and selling pressure. So the precious metal sector is quite large. When we look at it, even though they're all correlated together, I think they still all tend to go up and down at different times. Silver has its outperformance and then underperformance, and so does gold. Gold miners, and the overall precious metal sector is still led by gold. So to answer your question, I'm very, very happy to see gold break down and finally have, I think, what is going to be a first down year in 12, and also a first major bear market, which is a 20% decline or more since 2008. And I'm still a little bit worried that, a 30% correction might not be enough. Some people are still very optimistic, and majority are not anymore. Sentiment's really in the gutter these days, but some people are still very optimistic and they're still holding onto their views. And when I compare the overall situation in the precious metal sector today to the previous bull market, say 1970s, I think we're in the midst of a 1975 correction leading into 1976 bottom. When I look at my analogs, gold has corrected in time, because corrections go are measured in price and with time. Gold has already corrected in time with a lot of similarity, if not more than similarity, to the 1976 correction at the bottom. So time-wise, we've already gone for, I think, 400 plus days, which is almost like a 2-year correction. So consolidation has been quite strong in precious metals. But the price-wise, in 1975, 76 low, gold went down as low as 40+%. So currently gold has corrected 30%, and after having such a stellar run and being so hot for 12 years, maybe we will go down a little bit lower from these levels. Having said that, I think we're much, much closer to a major low, which I think gold will form over the coming weeks or months or maybe a quarter or two. And from that major low, I'm not sure if that's going to be retest of 1300 or a lower low or even a test of 1000 maybe. I'm not sure. I'm not very good at predicting these things. I've forgotten. I lost my magical crystal ball, which usually has been doing a good job before this in 2010 and 11 when precious metals were going through the roof. But having said all that, when we do form this major low, I think a great bull market is around the corner. It's going to be a multi-year rise where gold will exceed the 1923 high in September 2011. I think silver will exceed the $50 high in May 2011. I think the Huey, which is the gold bugs index, will exceed its high above 600 eventually as well, which was done in August 2011.
Tiho, let's back up for a second and look at some of the macro issues. I mean, apparently what's been hurting precious metals is the fact that all this money has been running into the stock market, running into the safe sectors where they can get yield, they can get dividends, while at the same time, since 2011, emerging market growth has slowed down. Inflation hasn't been as much of a problem, therefore that's hurt precious metals and commodities, and it's reinforced what I said earlier, the fact that we have a lot of money moving into the stock market. What's interesting to me is how just this negative correlation that we have, how over the last 20 months or so, precious metals have underperformed while the stock market has performed so well. What do you think it's going to take for this situation to reverse itself? Are we just going to have to be patient and wait for the economy to kind of hit a standstill and start to roll over? Could it be something in Europe? I know you're very in tune with the economic situation there. It looks to be worsening. What are your thoughts on some of these things?
Well, exactly right. I mean, the global macro picture is a little bit more complicated than just looking at a couple of assets as well. Having said that, not too many equity indices have performed as well as the United States, I have to admit. If we look at emerging markets, there's definite underperformance there. BRICS have been struggling actually since early 2011, November 2010. There's been underperformance in Brazil, which is a commodity-driven market. There's been underperformance in China, which is a commodity-consuming market. So, and then also India, even though it's done okay, it's had tremendous gains from March 09. Since 2010, it's really gone nowhere. And we can say the same thing about Russia as well, which is very highly correlated to the commodity sector as well, especially the energy side of things there. So those markets haven't performed really well. And I think that if we look at also frontier markets, which are the developing countries, third world countries, they have performed, they correlate very closely to commodities as well. Majority of these nations are actually commodity producers. They've actually down 20+% from their peak in 2011 as well. So yes, I mean, we've had great outperformance in the United States equities, but Europe has gone nowhere since, I guess, the bottoming of March 09. If we look at the FTZ ETF, which is the EU Stocks Total Return Index, they've just gone sideways. And then emerging markets and frontier markets have actually gone down. So there's definitely something wrong with the global economy. And the MSCI world, excluding the United States, shows that picture quite well. It hasn't exceeded the 2011 highs, which is the same highs for silver and for copper and for crude oil, for Brent crude oil, for a lot of industrial commodities in the CRB index. So I don't think that the world is performing really well, and somehow the United States seems to have, I don't want to use this word, but has decoupled somewhat. And I think it's less to do with the coupling of the actual fundamentals and more to do with money printing. Because if you have a look at the economic, if you have a look at the stock markets in the economies that are performing well, it seems to be just United States and Japan mainly. I mean, Germany has done really well too. But with United States and Japan, those are the two biggest money printers, and those are the two stock markets that are doing well. But if we take the whole context and observe the current developments, I think the precious metals have broken away from correlating with the stock markets, and also broken away from correlating with so much monetary reserve creation. But that is only a short-term phenomenon. I think eventually precious metals will recorrelate with the fundamentals, which is creation of money and money printing, and eventually we're going to have a great bull market. So a catalyst can be anything, but what's very important is that we follow the price action. And I think precious metals deserve to have a correction, as we already discussed in the previous question. Gold was overdue for one. And once we have a solid foundation, a solid bottom, where we shake out a lot of weak hands, because in my opinion, there was a lot of speculation in 2010 and 2011 in the futures markets and in precious metals physical markets. I mean, every single person I talked to was going to be buying gold and silver bullion and storing it in their farm with a shotgun and a tractor and so on and so forth. Once we remove all these people that are not actually meant to be investing in the precious metals market, and we shake out these weak hands, I think we're going to build a strong foundation and start rising up again. And I don't think at that point that assets such as US equities are going to be correlating with money printing, because while it might be beneficial right now, eventually when commodities really start correlating with money printing and inflation comes to the forefront, or at least worries of inflation, depending how you look at inflation, because if you believe CPI data, then obviously you're never going to see any inflation, thanks to Mr. Bernanke. But eventually, when commodities start rising tremendously, and this will happen because of shortages that are building up and the money printing that's being created, the stock market's going to be really struggling. So I don't think stock markets, in my conclusion, I don't think the stock market is a great inflation asset to be using to protect yourself. I think you're much better off being in gold and silver, but you just have to wait and be patient for that correlation to come back.
Tiho, I know you prefer the metals over the equities, but I've noticed that in the recent weeks you've been writing quite a bit more about the mining equities. Can you share some of your thoughts?
That's right. I mean, after something falls 60% and gets totally wiped out, I mean, you should definitely develop some type of interest in that type of an asset. I mean, I'm looking at certain charts, certain performances of gold miners, like the gold bugs index, dating back to the lows, in secular bull market lows in early 2000, 2001 area. And the way they performed, at one point in time in August 2011, gold miners were 16 times above their 2000 low, while gold was only up close to maybe 6 times, 600%. So they definitely can move very rapidly on the upside. But buying them at any other point other than the actual low, which is very difficult to time, but usually signaled well when the crash occurs, like the one we see now, one can and should consider adding positions to this type of a sector because they have tremendous upside. And the fundamentals, while very similar to the overall precious metal sector, still one has to be careful because buying individual companies, that carries a risk. So I prefer to just buy the overall sector, the overall index of gold miners, because I believe not every CEO is going to make a mistake. It's very difficult to buy, for me anyway, an individual company out of, say, 500 or 50, and the one that's going to perform the best and make sure that the management does the best thing. That's usually why I invest in metals. But the current opportunity here is great, and I think a decline of 60% and the one that we saw in 2008 of 70%, which proved to be a great bottoming and a great buying opportunity. I think this one here is just as good, if not better. So in the coming weeks and months, I'll definitely consider adding some positions to what I already hold in precious metals, which is majority silver and a minority gold.
Tiho, before we close, do you want to offer thoughts on perhaps some other sectors or markets? I think.
Yes, of course.
Yeah, go ahead.
Yes, of course. I was going to discuss a few things. I think I've said this before to your viewers and listeners, and I'm going to just repeat this again. I'm looking at the sugar market, which has been more boring than watching paint dry, I think, which has just gone nowhere since I've discussed it last time and the time before. There's just been a steady and slow decline from about 18 cents to 18 and a half, then 17, 17 and a half. Now we're at 17 and a half cents. I hold a position there, which was purchased in late 2012, and I will continue to build positions. For the first time, I think, since 2007, commercials, which are usually the smart money, the sugar producers, the farmers, the industry that knows better than the rest of us, they have turned net long. And the last time they did that, sugar, I think, was much closer to 7 cents before rallying all the way to 30 cents. Now, I'm not predicting the same outcome once again, but whenever smart money is buying from a contrarian point of view, we should also consider that. The bear market in sugar, which peaked in February 2011 at the peak of 36 cents, has now gone on for more than 2 years and has, I think, halved the value of the price of sugar. So when something is in a secular bull market, like I believe agriculture currently still is, and loses half of its value and has unbelievably negative sentiment, including public opinion and the commitment of traders positioning, and the daily sentiment index and all the other indicators that I follow, I think it's a great buying opportunity. The way people can expose themselves to sugar is via futures or options on the COMEX or the NYMEX or the CME. And at the same time, they can also purchase an ETF with the tag SGG. Personally, I think sugar is a very, very good opportunity to invest in, even if you just do a few percentages of the portfolio. It can be an outside investment where you take a little bit of a risk, and it can produce tremendous gains. So sugar is something that might not bottom today or tomorrow, but something that you should definitely have a look at, because I think in coming months and quarters and years, I think this asset can rise tremendously. It's extremely depressed on a historical basis, even if we use BLS CPI data. But if we don't use that, if we use certain other CPI data, sugar is tremendously cheap. It's something like 99% below its all-time high. And not that I'm predicting that it's going to go back to its all-time high, but you can just see how depressed the whole industry is. And finally, just one last thing I would like to say is from the fundamental point of view, I believe that a lot of Brazil being the largest producer of sugar, and China being the largest consumer, I think the demand is going to continue to grow and grow and grow. However, Brazilian sugar mills seem to be in a lot of trouble. And I think at least a third of them are on their way to bankruptcy from all the research and all the studies I've been doing. So if that was to happen at a certain point in time in the future, we could have a tremendous spike, because sugar is quite well known for spiking, not really rallying in a bull market like S&P 500, but just spiking tremendously. So huge upside here, and I think very limited downside. Buy some sugar.
On that note, Tiho, before we close, why don't you tell our listeners how they can sign up for your free newsletter?
Sure. The very easy way, just go to Google and type in short side of long, and they'll direct you to my blog, or just type in the short side of long.blogspot.com. That will also bring you straight to my newsletter. There's a little button at the top of the menu, which is called newsletter, and you just put your name and your email there, and you can listen to all the nonsense and read all the nonsense that I write about. Hopefully some of it makes sense.
Well, Tiho, on that note, thanks so much for your time today. I really appreciate it.